Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. Thursday, July 25th, Amanda recovering from her root canal.
You just doxed her again.
Huh?
Mean, she doesn't need people to know that she had a root canal.
Is that personal
I don't
thing?
know. Well, she's going to watch. I'm sure she's watching, and we'll hear from
Hi,
her.
Amanda. If you're watching, hello, Amanda. How are you?
Yeah.
It is Thursday, July 25th, 1 o'clock on the East Coast. Guy Adami, Dan Nathan, soon to be joined by
Carter Braxton Worth.
You stumbled on that.
No,
it's Carter Braxton Worth.
Yeah.
A fascinating day.
Yeah.
Fascinating day. By the way, listen, I'm going to stand up and say it. The effing Yankees got swept by the Mets this year.
4 games.
Yeah,
Home
and they got their asses kicked last night. And Bill Hockman, who I love, and I asked Bill if he was funny last night, and he said he was, which that's not what he said. He said, I crushed it. You know what? That's not a term I've ever used in my life, to be honest with you. I crushed that sandwich. It's such a whatever.
Right.
Anyway, he said that Aaron Boone should be fired. I'm like, okay, let's not get crazy.
Under the old regime, he's out. You know what I'm saying?
No, I disagree with
the way they kind of limped into the All-Star break. Yeah, they did limp into it, and they're kind of limping on the way out.
No, they're not playing.
All right, should we throw it up there?
Put the rundown up because listen, you talk about reversals. Well, look at that massive mega cap reversal, an S&P 500 chart check, and we actually addressed this yesterday. Look at where we traded down to. Fed expectations as opposed to great expectations. I see that might be Jacob or Timmy. I don't know. Audience Q&A.
Yeah, we're going to take a little bit.
So let's get right into it. And we did a lot of Q&A yesterday, I thought.
Yeah,
we did a good job.
Let's talk about just a little bit, Guy. You know, you and I, well, first of all, we have this great intern. Her name is Gala. Okay. And she's been sitting next to me a little bit.
What makes her great?
Watching the FactSet, because she's smart. She asks good questions.
Don't get indignant. I just am curious.
She's picked up a lot of things very quickly. Okay. But yesterday, she basically looked at my FactSet screen. You guys know this by now. I have a little bit of a heat map there. I have probably a few hundred tickers.
There's a salve for that.
Okay. And basically they're set up by sector. And she said at the end of the day, she's like, it is a sea of red.
She did not say that.
She did say that. And I started kind of pulling up some of the day charts, or a 2-day chart, a 3-day chart. And she's like, wow, that's nice. This morning on the opening,
sea of green. It was a sea of red again.
But there was one column that was all the tech that was red. It was actually panicky sort of action.
Sure.
But then everything else was green. So we saw money quickly coming out of the mega cap techs and then moving into even things like, airlines, which, were down after disaster. They were green, so it seemed like a lot of short covering as the mega cap techs got back there. But you know what? Here's the good thing, Guy. You just said it before. We have Carter Braxton Worth of Worth Charting.
He's going to help us.
He's going to help us think about the S&P in particular. Let's bring him in. Carter Braxton Worth of Worth Charting. There he is. He looks great. He looks great. Man. Carter, Guy said it's a fascinating day, and it has been a fascinating week or so, I think, in the markets, especially after a very complacent period. Guy, I heard this. So we've been talking about it. Liz has been talking about it. 355 days without a down 2% move. We had it. But the other thing I read, and I think Bespoke had this, the last period that we had this long, it goes back to 2003 to 2006. It was 900 something days without a 2% down day. Is that fascinating?
900 days. So we aren't even a record. Wow.
Yeah, but that's crazy. Carter, thoughts on that sort of price action to break that record? I know you don't give a crap about the records, but we broke it, and then we're rallying back here.
Yeah, complacency, and then a reset of sorts. And that's, if you think about it, that's the definition of trends. You get counter trends. The question is, and hard to know, we're down 4.92% as of today's low from the peak of just 5-6 sessions ago. And so the question is, has that taken care of it? One way to look at it is to put in the context of all 5% plus sell-offs in the history of the S&P. So you go back to 1927, the numbers are as follows. 239 times the S&P has dropped 5% plus. Now, the reason we use that as part of the study is because when you go down 1% in the stock, or up 3%, or currency or commodity down 4%, it's kind of noise. Most people don't really consider it much. Things sort of happen once you get down 5. Typically triggers some people's stop losses, a discomfort level rises, risk managers come into the room and say, we've got to talk about this. And so if you look at the data, as pertaining to all instances where you've dropped 5% plus. You have, again, some 239 instances going back to the 1920s, and they happen every 3 months on average. Well, guess what our last one was? It was April, right? The April sell-off was 5.9%. Here we are 7 months later. Today, as of the low, we were down 4.9, not quite 5. And so is this just yet a normal reset in the context of an ongoing uptrend? There's every possibility that's the case. One thing to keep in mind, if you look at all instances, once you go down 5, the average and median declines more along the lines of 9 to 11%.
All right, so let's take a look at why we stopped it where we did. And this is our chart, not yours, but I think you're going to like what we did here. So this is an uptrend that's been in place since November. We actually traded down to the third point today. Yes, we violated it briefly, but you can see what we did here. By the way, we also effectively stopped at the 50-day moving average. Those two moving averages are, I believe, are the 150 and the 200. But if we were to have the 50 in, you would see that basically that's where we stopped. So there, it sort of all makes sense. And we actually addressed that on the show yesterday to a point and last night on Fast Money. Now, I guess, and what you're alluding to is, what are we looking at here? Is this just a violent bounce in the context of what could be a larger move lower? Or is this going to look hauntingly familiar like we saw in April? And that's the rub. Now, I think this is just going to be a short-term, short-lived bounce. But, we'll see how it plays out, Carter.
Yeah, and very much the opposite in terms of internals today. Yesterday was about almost a 5-to-1 down day in terms of number of issues declining versus advancing. And today it's quite the opposite. You got a 4-to-1 day advancers. There are many ways to interpret it, right? A lot of big names are down to the penny, the 150 moving average, Microsoft, Amazon, bookings, and so forth. And then, as is always the case, there are a lot of things that are struggling. The one thing to note that the small cap continues, of course, to sort of hold firm, and that does have a little bit of import in terms of internals. We'll see. I think you want to buy things that have given you an opportunity by selling all the way down to the 150-day moving average. But the point of that is why are you in a position to buy something that sold off all the way down to its 150-day? Because you were trimming or selling when it was steep and uncorrected, right? And that's the idea. It's all about trying to be nimble if one can, and so forth and so on.
Well, let's talk about the nimbleness for 1 second. Carter, you and I were talking earlier on the day, and you talked to a lot of very smart, large institutions. You also talked to a lot of self-directed people who are semi-pro, that sort of thing. What was your sense about the positioning into this sell-off over the last couple of weeks or so? And again, there used to be a time where there's a lot more volatility. We could have, multiple, multi-percentage moves in a month or something like that. It just seems like obviously this has been kind of a low vol rally, but all of a sudden in about 2 weeks, you get this near 5% sell-off. How do you think people were positioned heading into earnings season right now?
Yeah, well, I can just tell you from my conversation. So one thing to note about a conversation with any portfolio manager is there's always an inherent bias. Someone who's long only has a certain view of the world versus someone who's long short, and so forth. But if you were to just look at the incoming emails, the IB chats, the Zoom calls, yesterday, the day before, and early this morning, basically the primary, and this is as groups, right? You got the long only mutual fund complex, you've got the pension plans, you got the long short hedge funds, and then of course the sort of smaller kind of family offices and things like that. But when on the phone, the overwhelming inquiry was, would you step in here in certain names that are down to the 150 moving average? And these are basically people who, when things were steep, had reduced. Doesn't mean that they were net short or anything like that, but had basically pulled their horns in as things were getting steeper and steeper. And so now that which was sold, they're looking to put back to work. So the SOX index is down to the penny. Amazon is down to the penny. Microsoft is down to the penny. You can go through the names. There's endless, but it only works. It's two sides of a coin. One can't say, I'll buy something that sells off. That's what GARP looks like, right? It's something that sells off to trend. But you have to have sold it prior or done some harvesting in order to have the capital to do it again, all things held equal. And so these are people who did de-risk and trim to some extent and some to a large extent who are now re-entering with that capital that was pulled back.
We haven't looked at this a while, but it's worth doing. No pun intended. Unfilled gaps, and you brought some graphs and some charts to illustrate exactly that, CBW.
Yeah, I mean, this was just trying to put in context. We now have 2 down gaps above, right? They're basically, as of 2 weeks ago, there were none. And now the market having gapped down aggressively in 2 sessions, almost back to back, we have unfilled gaps above. And then, of course, we have all those below. But if you look at the chart that might depict this, and we have that possibly, the blue solid lines were red dotted lines. They were unfilled gaps that have been filled. And so one could say, well, the 2022 bear market, S&P dropped 27%, NASDAQ 100, 37%. It filled a lot of unfilled gaps. It did. And so ultimately, will all of those unfilled gaps get filled? That's a real bear market, but certainly the ones that are sort of immediately below have to be a part of one's calculus. We might have another chart or two, but if we toggle those two, so there's with the gaps, there's now let's leave the trend, let's put the middle of the trend on the next, and so let's put them all together. Now we overshot the upper band, we're falling back into it. Now we're kind of bouncing here a bit, but this is the compass, this is the map, this is this is what to use to try to figure out where one is, right? It's like the "you are here" arrow on the map. Wow, we've come a long way compared to the low. Wow, we've sold off a bit from the high of 4 or 5 days ago. We're sort of not really even anywhere near the middle of the channel. You have to have reference points when you make your decisions, just as a fundamental analyst uses, wow, it's only trading at 3 times cash flow. It usually trades at 6, right? So forth and so on.
Yeah, this is interesting stuff. You had a long-term S&P chart. Maybe Jacob can bring that up as we're talking, going back to, let's say, 2009 guy. This is kind of post-financial crisis, or when we bottomed. I think it was kind of March, April of 2009. And you had a chart the other day. You were talking about the upper end of this long, 45-degree angle for all intents and purposes. Carter, what do you say to people that say, well, these are just blips, 2022, COVID, 2020, in what is just a, really secular bull market here, and that really any meaningful drop that we have 10% or below, as long as there's nothing structural that looked like 08, 09, or the lead up into that, or a black swan event like COVID that got bought really quickly, or when we talked about 2022, just the orderly nature of that sell-off, where we at our lows were down 27%, with many stocks down 60, 70, that sort of thing.
Oh, correct. So that's not a blip. That's the thing, right? I mean, 27%. It's all a blip if you take a 50-year chart, right? 10-year-old, you can't even see the 19. But then one is, and that's fine. One is just in the buy and hold. One's betting on America, right? Betting on innovation, betting on progress, betting on humanity, if you will, and that there's always, one day it was Polaroid and Xerox and IBM, and now it's Apple and NVIDIA, and then someone else will come to the fore. But the point is, that's a buy and hold, and there's nothing wrong with that, but that's not what trading is all about. Trading is trying to generate alpha on an intermediate basis. There are only 3 time frames: minor, intermediate, and major. So if one wants to play major, okay, put it all in the child's 5 through 9 plan and don't talk about it, right? But there's not a blip. 2022 is not a blip, right? As you point out, many stocks were down 50, 60%. S&P down 27. Yeah.
What's going to be interesting is this next chart. And again, if you had asked me to say, okay, what is this going to look like? There's no way I would have said that both the NASDAQ and the S&P over the period that you've displayed here are up the same amount. Yet here we are. So walk us through why you brought this, because there's obviously and again, this actually surprises me a great deal.
Right. I mean, it's trying to make the point. So there are 2 lines. Let's say you didn't know what they were. They were, one's a tortoise and one's a hare. Okay. It doesn't matter what the hell they are. One's a blue car, one's a red car. Okay. Which is the better result from the left to the right? The better result is the blue car here versus the green car. They have the same outcome, but look at the path traveled. Right, which is to say the NASDAQ 100 over the past 3+ years is actually the substandard performer. And you could say, why? They have the same result, but it's all about risk-adjusted returns. The S&P had a 27% drawdown. The NASDAQ 100 had a 37% drawdown. So when adjusting for that fact, the NASDAQ 100, the great NASDAQ 100, which has all of the growth, all the innovation, and I did this from a time frame when AI didn't exist. So you just do Google searches AI versus now where it's literally the most popular thing you can talk about. This is pricing in AI, has been coping with AI, has reflected AI, and the green line did worse than I'm sorry, the green line, did worse than the blue line. How is that possible? It just speaks to, it's never quite as clever as the headlines. Oh, you got to be in QQQ.
Yeah. Well, we're never as clever as we like to think we are. Well, listen, Carter, we really appreciate the heavy lifting on the S&P and obviously here in the NASDAQ 100. We're going to let you go, man. We appreciate it. It's a busy day. Thanks so much for being here with us. Guy, the big news of the day, aside from the price action, was this beat in GDP for Q2. I think expectations were 2%. It came in at 2.8. Last quarter in Q1, it was 1.4 or something like that. So we doubled it up. Now, I know what you're going to say. These things often get revised lower here. Just talk to me a little bit about when you see that sort of beat, what that means to you, because we're going to talk about rates in a second. And it seems like there's some competing forces going on with what the Fed may or may not have to do as it relates to interest rates.
100%. So, you know, David Rosenberg, so this is now 3 hours ago. So you know, after he put out a tweet about the GDP and, you know, basically, and I'm going to read this and we can pull it up if Jacob can find it. It was David Rosenberg, 3 hours. Fully 80% of that reportedly solid 2.8% in real GDP growth in the second quarter came from three sources: savings rate, savings rate drawdown, government sector, and inventory build. And he said, but for that, and I hate using that term.
Well, why? Because you know what a but for is?
Exactly. Yeah. It would have been a much different number. He said we would have been at stall speed. So what I think what's going on here appears to be some, I don't want to say finagling, but there's some massaging of the numbers. Now, if that number was as strong as the headlines suggest, in my opinion, 10-year yields would be markedly higher, and they're not. So I think the bond market is suggesting maybe their strength in the GDP on the headline is not all that it cracks up to be. So the price action sort of makes sense. But to your point, your broader question is a lot of cross currents here. I think the market is still grappling with, what is in fact going on. Are we seeing a, reacceleration of the economy, or is it just, something else going on? And then couple with that, when you start seeing the unemployment rate ticking up, what is that going to suggest? So there's a lot to unravel here without question. So just looking at I'm not suggesting you're doing this, but just looking at the headline, I think you got to go deeper into the numbers.
Listen, and a lot of folks do just look at the headline, right? And they say to themselves, well, quarter over quarter, right, we're seeing, like growth accelerate kind of meaningfully. And so, again, if we had come in a little lighter, you'd say, well, we're below trend, right? That sort of thing where, and so, better sequentially than the other one. Let's just take a look at the CME FedWatch tool here and what expectations are for cuts. Obviously, the meeting this month, which is coming up in just next week.
I think it's next week.
Yeah. The expectation is nearly certain that there won't be any price action. But then if you look at it somewhere in like the 90% sort of range or a little higher than that for September. And then November, we're pricing in basically 50 basis points at that meeting. And that's like a 65% probability of that. So again, Guy, we talk about the long and variable lags of the change in monetary policy. And it seemed like, the Fed signaled they were going to start raising rates in late 21. They did it throughout 2022. We had that bear market. The recession never came that a lot of people expected. Carter just mentioned it. This AI phenomenon, mania, took hold in 2023. And despite a regional banking crisis where we lost, a half a dozen or so, regional banks, we just were off to the races.
That was the best thing that happened in the market. It's, again, in retrospect, that regional bank, that Silicon Valley Bank, was the best friggin' thing that happened to the market. Because the liquidity that came in on the backside, and that propped everything up without question. And I think it just elongated the inevitable. And again, I don't play the economist role, but we had a long conversation with Elizabeth yesterday, and all the indicators that she looks at closely and I look at sort of peripherally are indicating that it's just a matter of time. So we'll see. But in terms of the Fed rate cuts, I'll say this again, be very careful what you wish for. And I know Bill Dudley had a piece saying, now's the time to act. I think when the market has days like yesterday, people are alarmed by it, and they said the Fed's got to step in. But again, you have to be careful. And we talked about the 210 spread getting down to about, I think, 11, 12, 13 or so basis points of inversion. Again, Elizabeth says this, it's not the inversion that gets you, it's the re-steepening. So all these things have to be on your radar screen.
Well, you just said backside, and that brings me back to something we said before, or you said before, but for. And so a but for, a backside, you know what they're for?
Not sure.
Sitting. Yeah, which is what
no,
we're
it's
both
funny.
doing.
Well, no, I am sitting. I don't even know if I should, but not that anybody cares.
I mean, I made the joke. We're moving on.
Let's move on.
Okay, so
if Amanda were here, she'd be like, "Oh my God, please stop."
All right,
but she's not. She had root canal.
Yes,
as I mentioned.
That's you did.
Doxing her again.
We just did the 210. Let's look at the 10-year yield here, and then we can look at the 2-year for a second here, Guy, because again, we know how that steepening is happening, right? The 2-year, which is kind of most attached to what the Fed funds rate is going to be. We
dropped like a rock,
right? So Fed funds by November is pricing in down 50 basis points on the higher end. You see the 2-year coming in. 10-year is just kind of stuck here, and again, I mean, so I just want to finish one point. So if we talk about the long and variable lags of this, even if they cut 50 basis points this year, you're not going to see a whole heck of a lot action. You might see mortgage rates come down, right? You might see access to capital. That might be, maybe we can pull up the Russell 2000 for a second. And Carter just mentioned this. I mean, this thing has been volatile the last few days, but it's in the same range, Guy. You know what I mean? So it tells you that when it's down a little bit, it's being bought, right? And so this has happened even in this rally back in the mega caps today, but it's clearly been a beneficiary of some sort of rotation.
Yeah, well, yes, I agree with that 100%. But again, if things, GDP print today notwithstanding, if things are slowing, it's going to create this sort of false breakout, I think, in the Russell without question. I understand why it's rallying. I understand the catch up. We've discussed it a number of times. The question is it sustainable like Tom Lee thinks, or is this just sort of a bit of a blow off here? And are we going to stall at prior highs, which I think is going to happen, but we'll see how it plays out. The other thing we have to look at, I think, is crude oil, because that's been, just when it appears it's going to sort of break out again to the upside, it goes right back down. And you've had a really nice call on this thing. So here's the underlying commodity. What I find interesting, though, Jacob, if you could do this real quick, some of these energy stocks today are having a day. I mean, look at the OIH today. The last I looked, it was up pretty significantly. I think it's trading around 330 or so, levels that we haven't seen in a bit of time here. I mean, you go back to middle of July, but, all these are levels we haven't effectively seen since April of this year. So the OIH is telling a story. If you want to throw the XLE up, that's going to tell a very similar story. That's been hanging around this 92 level. So energy still looks interesting to me.
Yeah, no doubt. And energy is interesting to me also because, here, let's just say we're above trend in GDP here in the US. Let's say that number gets, kind of ratcheted down, or you want to explain it away by inventory build and government spend and all. I get that. You know what I mean? Like, this has been a kind of noisy number for a long time. And a lot of people just say, depending upon how you calculate it, makes sense. But overnight, you saw that the PBOC, so this is the Bank of China,
People's Bank of China,
they lowered interest rates. And we've been talking about their GDP number, which came out, I think, a couple weeks ago, which was the lowest in a year. And so that brings me back to crude, Guy. Okay. And you see what's going on there. It did have a meaningful sell-off. I think, again, was about 10% or so from those recent highs. This tug of war between, maybe our economy, maybe led by the consumer, is weakening here. Maybe the unemployment is ticking up. We're going to have to see another reading on CPI in a few weeks. What the July jobs number, but maybe we kind of get through this in the near term until we get those cuts started. And, I just don't know. But the tug of war is between weak China, right, and what's going on over here. And if we kind of join the party on the weakness, then you have a global growth scare. And the last time we had that was late 2018, guy. And what happened between October and Christmas Day? And
between Halloween, and Christmas Day.
Well, how much did the S&P sell?
19.9%.
Right. And you know what it took to kind of stop that?
Jerome Powell,
it
kowtowing to the administration and getting spooked by the market.
Okay.
And no,
and then
but it's not okay.
No, and
that's what happened.
And then it was.
Tell me that's not what happened.
It's exactly what happened. But then the market.
But you say it so dismissively.
But I'm sorry. I don't mean.
By the way, you notice Jerome. Listen, I have never met the guy. No. I'm sure he's
lovely. But a little pointer here. So whenever Guy says, when he prefaces something, I'm sure he's a lovely guy.
Yeah.
You're basically
predisposed not to like him.
Yes. Yeah.
I haven't liked any, I go back to Paul Volcker, who's sort of my
old
hero.
School. Yeah.
Since then, it's been Greenspan was a disaster.
Didn't Volcker always have like
that
a cigarette
Bernanke guy was
like
just an abject. That guy really irks me.
That's a great. He took a job at Citadel like the day after he left.
Yeah,
I know.
Yeah,
I know.
I mean, I'm all for making money. You want to do a book tour, but going to. Okay, we're off topic here.
Yeah.
But going to a place like Citadel, which all they're going to do is sort of pick your brain and understand sort of what are the soft spots and what are the basically where can we take advantage of what you've created? That to me is problematic.
No doubt.
Okay,
I want to hit this on the back of yields. Okay, so let's look at the U.S. dollar.
He might be watching right now.
Yeah, let's look at the Dixie.
If he is, you're an asshole.
The U.S.
Not you, him.
Yeah, I know. But you, every once in a while, you'll call me that.
No,
I know.
Have I ever called you that?
Do they want to hear the story the first time we ever met on the set of Fast Money?
No, this is your version of it.
May of 2009.
Good. So Amanda's not here.
I just started doing
Bill Hochman. You listening to this?
I started doing Options Action, which was a show that at the time, you ready for this? They filmed it on Friday afternoons. They put it on CNBC at 11 o'clock. I'm not lying.
On Friday night.
PM. Okay.
I mean,
I know. Okay. You're gonna say
you got to be.
You'd have to be a real Johnson to be on that show.
If you're watching CNBC at 11 p.m. on Friday night,
they played it again at 7 a.m. the next morning.
Even better.
Okay.
Wake up early.
But
hey, what are you going to do tomorrow morning? Well, I'm going to wake up and watch replay of Options Action.
Can I ask you a question? How did you feel when after a couple years after I was on, they cut Fast Money in half?
Yeah, they did. Actually, no. Let's go back for a second.
Yeah.
They actually cut it all together.
Oh, yeah,
because there was Money in Motion as well. MIM.
That was a Max Myers production, both of them.
That show sucked.
But then they canceled that show
because it sucked.
And then Fast Money went back to 5 to 5:30, and then Options Action was on that time for 10 years.
Okay.
All right. So I start doing Options Action in April of 2009. Mary Duffy says to me, and she runs all the talent. She's a genius up there. We'd like to raise your profile a little bit on the network.
Right.
And so she's like, would you go on Fast Money and talk options and this one? So I go to the NASDAQ and I go on the end of the desk.
Okay. So stop for a second.
Yeah.
This is all that was factually true.
Until what? Right
no. Now this is your version. I just want to be crystal clear. Okay. Now this is your version of
you
events.
Don't even remember it, but it was a formative experience for me at CNBC in my early days. So I know Mel because she's the host of Options Action. And I was we only did like 3 episodes. Okay. And I stand at the end of the desk. They bring me out during a commercial. They bring it back here. All right, we have to talk about AMAT's earnings. They report tomorrow. We have Dan Nathan from CNBC's Options Action. Blah, blah, blah. It's a new show. Blah, blah. And not a single one of you guys looked up and said, hey, how are you, bro? Or anything like that. You
know,
whatever.
I've never used that. I've never
and I walked off,
bro
I
in
walked
my life.
off that set and I said, I'm never doing that show ever again.
That's your version.
Yeah.
Okay. That's the way you remember it.
Yes, I do.
And there's the saying, perception is reality. Bill Hochman, are you listening to this? Because this might be good material for you. Perception is reality. Okay. There was a movie, I don't know if you remember it, Platoon. Remember this Platoon?
Great movie. William Dafoe, Tom Berenger.
And they would
Charlie
ask
Sheen.
Yeah. So when people were in the shit, and I want to be crystal clear.
And you have a lot of respect for all those people who
but I was born in 1963, so I was too young for Vietnam. So I wasn't gonna, and it never dawned on me that I could go to an academy or enlist. That was just not in my. So anyway, there was a saying: if you're in the shit, you didn't want to get to know the names of the new guys.
They call them grunts.
Bill is doing. I don't know what this means.
They call them grunts
because there's a good chance they weren't going to be around in a couple weeks. So why bother getting to know their names if they weren't going to be there in a few weeks? So the way we looked at it, because you weren't the only one. They paraded all kinds of slapdicks over that desk. So how am I supposed to know that you're not going to be one of them?
All right.
No, but my point is, from my seat,
I'm still here.
You're just one of many that came
and
through.
I'm still here.
So for me, being, I was in the shit for a while. I wasn't going to get to know your name until I needed to get to know your name, and then it happened.
And then when you got to know
that's
my name,
why again, that's your version, and that's my version, the accurate version.
When you got to know my name, your pretty cool. We developed a great friendship, and here we
Absolutely.
are. We're podcasting here.
No. But that's, so
bringing it back on the rails, and I know I started that.
You did.
Okay, let's look
Bill,
at
you can use that tonight if you want.
Look at the U.S. dollar index, the Dixie guy, and it's interesting because, okay, with like weaker rates, you would expect the dollar to come in a little bit here. You can obviously just visualize that uptrend that's been in place from late December, and that was a huge move, guy, that we saw from 107 in October.
Yeah.
That's when the 10-year yield was at 5%. Okay. And you saw that the 10-year yield came all the way back to 385, and the US dollar index from 107 down to 101. Okay. So
it doesn't sound like a big move. It's a big move in the currency. Anyway, continue.
Yeah. And so, it seems like this 104 level, guy, is a level. Kind of broke below it. We got back up just a week ago or something like that. You see that 200-day moving average. And again, not that important in a currency, but could be near-term resistance. So if you were to see the dollar go back towards 103 and then maybe towards 102.5, which was that kind of March low, let's bring it down to gold. What would you expect gold to do in that scenario? Because gold is back and filled. You know what I mean? Let's bring up the gold chart for a second here.
I'll play your reindeer game. So if the dollar would sort of continue this trajectory lower, one would think that gold's going to get back on its horse and head higher. That makes sense. There are so many odd things going on. This dollar move is odd, but not only that, I don't know if Jacob can do this in real time. I apologize, but pull up a Japanese yen chart because this is one we've talked about for a while. Obviously, we saw the move up to 160. We saw the subsequent intervention in April twice, got it down to 152.5, traded right back up to 160, and now here we are. I mean, dollar yen has cascaded lower. We're right at a critical support level. So not only is the dollar weakened against basically all the currencies, it's really weakened against the Japanese yen. So we're going to see how that plays itself out. I don't know is the short answer. Now, going back to gold for a second.
Do a 6-month chart on gold, because I want to isolate
this.
Consolidate. No, yeah. All right, speak to
it. But it's going to look like a lot of sideways action. I think it's consolidation for the next leg higher. There are other people that would say, you know what, guy? Once again, gold's going to be this huge head fake. It's just going to give it up like it always does. You're getting ahead of yourself, which, you know what? It's hard for me to argue that because historically that's been the thing. I will say this. The gold story is not over. And X today, which are not trading particularly well, the mining stocks put up AEM, for example. That's Agnico Eagle Mines. Look at the move of this over the last.
That's the A or clam on CNBC's Fast Money.
I'm glad you remembered that. But look at this move over the last 6 months. I mean, this doesn't look like a lot. If you extend it out, you'll see. I mean, this has actually been a pretty significant move. Gold mining stocks don't move like this.
Hey, let's go back to the 6-month of gold. So, guys, this is really interesting to me. Today's price action, big day, down 2.5% or 2.25% or something like that. So let's move that out a little bit. So you see that level that we bounced off of. We bounced off of it in late April. We bounced off of it in late May. It really feels like in late July we're going to go back there. Maybe you see the 200 or the 150, kind of working its way up towards those levels. 2,300 seems like I'd almost want it to go there kind of quickly.
No, I
understand.
Know what I mean?
And then kind of that's what you would take
Flush
your
some
shot.
People out.
Yeah,
no,
I would almost take a shot at like 2,350. I'd use like a 23 stop. You know what I mean?
Next week,
does that make sense?
You know what? Next week,
we'll see where it is,
and we'll tease a little trade.
Yeah,
Bitcoin is one which. Again, the recent volatility in Bitcoin, I think, is interesting. We traded down to 56,000-ish, traded up to 67,000-ish, have a pretty big downdraft over the last couple days. I don't know what it's on the back of. Again, I'm trying to figure out what is Bitcoin predicated on. And by the way, we had a great conversation with yesterday that's going to drop on the Monday B block of On the Tape, where we discuss Bitcoin and all crypto at length. Anyway, please continue.
Well, it's interesting on the Bitcoin really quickly. It seems really correlated, I think, to these mega cap tech stocks. And we've made that. So, look at how the NASDAQ has come back from today's lows and look at how much Bitcoin is off of its lows. It traded 63,451. That's in the futures. And here we are at 64,783. So again, let's see how this goes. We got to talk about this reversal in the mega caps, guy. Yeah. So let's just start with NVIDIA. Maybe Jacob can bring a 3-day chart up and then we'll kind of back it out a little bit. We'll go from there.
So yes, okay. I want to be also clear that, twice as shitty as I've been, and I've been shitty.
No,
I'm just saying, In March, on that March 8th Friday, we flagged the NVIDIA action. That proved to be correct. On June 20th, we did the exact same thing. And in retrospect, with today's low, it proved to be spot on. The all-time high NVIDIA was 141. Today, we traded down to 106 and change. Percentage-wise, Dan, that's a pretty significant move.
25% or something.
Same type of move that we saw in April, number one. And by the way, I'm not suggesting it might not be over. So we'll see. But to your point about reversals, today is an interesting reversal day. We obviously, as I said, traded down to 106 and change. I think we traded all the way up to 116 and change. We'll see how it shakes out the rest of the day. But this is absolutely worth watching, and I'm glad you pointed it out.
All right, so you see that kind of that thing right after the opening, it just fell off a cliff.
Yeah, it did.
And you see how quickly it came back. So one of the things that Carter and I were talking about, and he mentioned it just 20 minutes ago, that some of the like big money sort of folks, they were looking for this opportunity to get back in some of these names, and I think that's kind of what happened. I saw it down 6.5% after yesterday's down 6%, and it felt a little bit panicky,
overdone.
Yeah, you have that overdone on a near-term basis. Yeah. And I think your point is like, do rallies get sold right now? And that's why this afternoon between now and 4 o'clock, I think is really important, because if this thing, starts heading back down towards 110, you know what I mean? And then then you would expect all these kind of semis to follow suit, a lot of these kind of mega cap tech names that are their customers. And I want to make one point.
Please.
Why do you think this started to happen just a couple days ago? We had Google report Tuesday afternoon, and you and I were on the Fast Money desk. We were talking about their CapEx. It was not higher than folks expected. And I think that was really important. And I think that, maybe people didn't extrapolate it right away, but Tesla's CapEx wasn't greater than people expected. So if you have these mega cap companies pulling back on CapEx, and we talked about this last week, that means they're trying to manage their numbers a little bit, or the return on that investment is not coming through as you would expect.
It's the ROI. I'm telling you, and we've talked about it. And then Sequoia talked about it, and Goldman Sachs talked about it, and Roger McNamee. Now this week, you have more people talking about exactly that, the ROI on this spend. More and more people are going to start to, I think, take a look at it. And if in fact they don't see the benefit, what's going to happen is all the things that you've talked about, all that double and triple ordering is going to be flashing red. Margins, which for NVIDIA were 77%, will begin to contract. And when that happens, it's watch out.
Well, I don't want to make the other point is that on that CapEx front, these companies, 40% of NVIDIA's revenue is Meta.
Three names, I think.
Yeah, it's Microsoft and it's Amazon. And when you think about the tens of billions of dollars they've spent over the last 2 years, I just want to put this in some context. NVIDIA in 2022 had $27 billion in revenue. In 2023, they had about 57 or something like that. So it doubled, 100% year over year. This year, it's expected to have 115, 120 billion, doubling again. Okay. So I guess my point is like, if the CapEx starts to decelerate, you know what I mean? Like, then NVIDIA is going to have a problem. I think that's what's being priced in. And the last point I'll make here is that next week you have Microsoft and Meta reporting. And if they don't guide higher in CapEx, and let's say the numbers came in line the way that Google did, you know what I mean, a couple of days ago, I think the sector has the sort of move from July of last year to October of this year. Now, it's come off really hard. The S&P was down, 5% or so, guy? Carter just went through that. And a lot of these names, look at Tesla's down 25%. Amazon's down 15%. NVIDIA is down 20+%. Even Apple was down 9-10% at its lows here, guys. So obviously Google, Meta, they've all sold off. So more than the S&P 500. That's why next week's really important.
It's that time for questions.
Oh, yeah. There we go.
So Jack is with us every day.
Thanks, Jack.
Hashtag Fed. Will do its I think this is a statement, and then he's asking us if we agree. The Fed will do its third rate cut end July. Hold on a second. We'll pull it up because I'm trying to figure this out. Fed will do its first rate cut end July, once again in September, and this cut. And
so he's saying
there's going to be a cut in July, again in September, and I do not agree. I don't think there's going to be a cut in July. I do think there's going to be a cut in September. I think what's more likely is instead of a July rate cut, a 50-point cut in September, and then again in November. So it gets you to the same place, but it gets you there in a different way. That's what I could see happening. But again, I think embedded in that is it's going to be bullish for the market. I'm not sure that's the case.
Yeah, some folks are talking about, obviously July, it's not priced in. That would be a big surprise. I'm not sure, Guy, if they cut 25 basis point next week, how the market would react. It would be, you know what I mean? It would almost signal the fact that they're worried, not that they feel like they've done their job on inflation, but they're worried about a weakening consumer and a weakening economy. And, the other thing I would just say is like the likelihood of them doing 50 basis point cut in September, that's when it would be an all out political war about that. So I think a 25 basis point is probably makes some sense and stuff.
Brian McGinty, if rates are cut because inflation is subsiding, it's different this time because employment is good. Well, employment appears to be good, but we had a conversation yesterday, as I alluded to earlier, with Elizabeth and this SOM rule that's going to kick in if the unemployment rate ticks up to 4.2%, which, by the way, I believe that it will. So employment looks good through the lens of headline unemployment, which is still historically low. Mm-hmm. But if you dig deeper, it's not as strong as you think. So I don't think the general health of the economy is well. I understand the bull case is they're cutting rates because they can, because inflation is subsiding. It's not going up as quickly. That's the bull case. I'm not convinced, though, that's exactly what's going on.
Yeah, I mean, I don't have much to say there.
All right, so if you don't have much to say, we're going to move on. You a fan of ABBA?
What do you think?
No, but they sang a song, Fernando. There was something in the air that night.
It's one of their worst songs. Actually.
The stars shone bright.
I did see the what was the play? I saw it in London. It was the ABBA play. It was
ABBA.
Like 25
it's the one
years ago.
Kiss. Mamma Mia.
Mamma Mia. Horrible.
Whatever.
Okay.
By the way, Bill Hochman said to say slapdick again. Slapdick. It's a great line, by the way. You should use that in your routine. You should use it when you heckle your audience. Please ask CBW about. Well, he's not here anymore, so let's
I'll play CBW.
Ian Carter, what do you think about ENINCY, which had a decent day today?
Well, why don't you give us? You're pretty good in some of these biotech names. Thoughts here on? You know anything about this company?
I saw the headline today. I mean, this is what I'll tell you. We have a bit of a double bottom, and we actually talked about. I remember talking about this on Fast Money a while ago. This is something you can trade against in the form of that double bottom. Proven to be correct.
Yeah.
Excuse me. The level that we traded up to today, though, is going to sort of mirror the levels we saw earlier in the year in January. Now, I understand we've overshot it a little bit, but on a volume day like you're seeing today, and give me a second, I'm going to look at how much volume is traded. This is one where I think, off the top of my head, hold on.
Pull up a 5-year while he's doing that.
Yeah, you know what? We've already traded about 4 times normal volume. Means we'll trade about 6 times normal volume by the end of the day. I mean, my sense is we're going to sort of stall out here.
Well, here's the other reason why we might stall out here. Can you draw a trend line from that high, going back to 2020 there, Jacob? And, we see that 200-day moving average guy right there. Mm-hmm. So this is purely a technical standpoint. And you know what's interesting? Yeah, and attach it to that that high from early 2023. You can see what's going on.
Yeah,
there.
Downtrend line, moving average, prior high. I mean, so this has had a great run. If you're asking me, which you are, because you asked the question, I mean, you got to do something. If you've been long the stock, you got to move your feet. What does move your feet mean? You got to sell quarter, third, half. You got to buy some protective puts unless they're ridiculously expensive, or sell some calls here. Do something. Don't sit and watch.
I want to make one other point,
please.
Guys. So go back to this kind of 2022 period when you see that. It looked very similar. You had like a double bottom there. You had a little bit of a breakout.
And then right back down.
And not only did it go down, it went from like kind of 85 down to nearly 50. So here we are, back at 70, like from a technical standpoint, and you were asking for Carter. And so we're just going to stick to the techno. It looks like, I think Guy's got it right. What else you got, Guy?
You're going to play the role of Tim Seymour?
Sure.
Every time we talk about big cap pharma, you say it's Tim's what?
It's Tim's Pfizer.
There you go. So let's pull this short because you can play the role of Tim.
So we played this, we actually played this on the long side, Guy. Do you remember the calls?
And it worked out really well. That was a few months ago. Is Pfizer turned enough over the 150-day moving average to look at the stock for the long term? Throw up a Pfizer chart. This is from Ramesh. So Pfizer's got its own issues. This is what's going to happen with Pfizer, I think, if you're asking me, which you are.
Yeah.
It's going to be, the injectable GLP-1 stuff. They're going to make an acquisition. The market's not going to like it at first, and then I think the market's going to like it a lot. So this is, to me, this is a bearish to bullish reversal. And you can see the moving average starting to flatten out. You can see that whole rounding bottom. So the short answer is yes, I actually think you can stay long Pfizer here.
So I want to make a point. This is kind of an interesting one. I actually, they're probably working on an injectable, but I know they're also working on an oral, and so that could,
did I say I meant oral? I apologize. I meant oral.
But the oral is really interesting because as you get greater supplies of the injectable, which for the most part people are going to have to start on, the oral maintenance is going to be there's going to be a long tail in that, right? So look at that. I love
that a side effect?
I love your bearish to bullish.
You hear that, Bill?
Yeah.
That was pretty funny, right?
Your bearish to bullish reversal.
I think side effect.
I want to make one point. So in 2022, this company earned $6.50 in earnings, and we know what that was. That was the COVID shot, right? And so
what is it, like a third of it now?
Yeah. No. Well, listen, they did $1.85, so down 70 or so percent, and then they're expected to see some growth this year, 237, 275 next year. And what's interesting about that, this stock trades at 13 times earnings this year. It trades at 11 times next, and so if they ever have a reason to buy this, or there ever is something attached to the GLP-1 trade, that could be very interesting. I agree.
What else? I was going to say, look at IBM because people laugh at me about IBM.
No, you had a good call on that, Gary.
Well, it's again 2 days in a row we did like an hour-long show. People are getting sick of us, but Amanda's not here, so she can't stop us.
She cannot.
By the way, if you want to go see, if you're in New York City,
and
you want to see great comedy, Bill, where you got a gig tonight? He's not even paying attention.
No, he's so bored.
Text me where it is. You dumb shit.
By the way, Guy and I we have a really exciting On the Tape podcast that's going to drop tomorrow in your favorite podcast store. We have Danny Moses.
Yeah, sure.
We have Vincent Daniel, and we have Porter Collins, and they're going to have a What Are We Doing? And the three of us, Danny, you and me, are going to start things off. It's going to be very different than what you just heard here. So
no, it's always different.
Go to your favorite podcast.
I might curse more. By the way, Greenwich Village Comedy Club. If you're in New York City, it's a Thursday night. You got nothing to do. The Greenwich Village Comedy Club. Wait for Bill Hochman to get on and heckle the shit out of him.
There you go.
Because you know why? Because he can take it.
Yeah, he can.
Because he's qualified to deal with it. I've seen it happen.
He does a lot of crowd work.
What?
So pick on somebody in the front row. You know what I mean? Like what is that? He's ever noticed this?
How'd you guys meet?
Yeah, a lot of that
on
stuff.
Dating app. No, I've seen the whole routine.
All right, should we get out of here?
He likes the term slapdick.
All right,
it is a great term that is not used often.
By the way, so this is a little game that's played on the set of CNBC's Fast Money. So if somebody says something, there's something comes in, you try to work it in. You know what I mean? Like, so if someone said,
well, that's a hard one to work into Fast Money.
Well,
I mean, it's not that. Listen,
maybe the halftime.
Can I tell you something? Well,
all right.
I am not adverse to doing it.
Yeah,
but it's something that
All right, guys, let's get out of here really quickly. A little housekeeping. The On the Tape podcast drops tomorrow morning. Danny, Vinny, Porter, that's the Big Short guys. Check that one out. We're excited to hear that. Also, we have the Market Matrix. It's been around for
look at that.
10 weeks or so.
11 weeks.
So we curate what we think are the 10 top business and market stories. We put it into a large language model. We take the text and we put it into a voice bot. That voice bot is Brunson. Okay, that's MRKT Matrix. Go download it, rate it, review it, share it, because that's how people find it, Guy.
Share. That's fair.
Okay.
I went to school with a guy.
Yeah.
And I promise.
Croton on the Hudson.
Yeah. And there were 3 boys in the family. Boy. And the father used to put out 2 chairs at the dinner table.
Yeah. One was for Elijah.
No.
Oh.
No. I don't know who Elijah is. I really have no idea.
Passover?
No. So 2 chairs, 3 kids. And I'd be like, that's interesting. And he'd be like, yeah, we had it's sort of Darwinism. You had a fight to get, if you didn't get one of the chairs, you're shit out of luck. I sort of dig that. That's a good parenting style. No, you disagree?
Well, you did parent 3 kids, and you never thought of doing that. And there's after you knew about that, as you grew up.
No, because it's a different time now. People don't eat dinner at the same time together. People eat all different times. Like I'll come home, I'm like, boom, you hungry? He's like, I ate already.
He already went to the Chipotle.
He probably did something.
Yeah.
So I mean, it's just you're sort of sitting there by yourself.
All right, we should get out of here.
Salisbury.
I'll tell you why we got to get out of here. Because we have to do On the Tape podcast, and then we have
to
jackass it up to the
That's it for Market Call.
Money.
Thanks for joining us.
Thank you, guys.
See you later.
Bye.